The Federal Reserve Bank just took a 180 on their inflation stance because Jerome Powell, the chairman of the Federal Reserve Bank, came out publicly and said that he was wrong about inflation. He said that he needs to, quote, retire the word transitory because inflation is not transitory, and he also said that inflation is worse than what he expected it to be. What's up, everybody? I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. The Federal Reserve Chairman Jerome Powell and the Treasury Secretary Janet Yellen had a hearing where they both sat down with Congress and they spoke to Congress members, where Democrats and Republicans drilled the Federal Reserve Bank and they drilled Janet Yellen, trying to understand what's going on with the economy and trying to understand what's going on with inflation. The three big topics that they discussed was inflation and the high cost of living because people are struggling to afford their lifestyles. Second is this great resignation because you have a lot of people quitting their jobs, you have a lot of people not working and they don't know what to do about that. And now you have this new virus and how this new virus can affect the economy, the employment, and inflation. For more than a year now, the Federal Reserve Bank and the government have come out and said that this inflation is transitory. This high inflation is going to go away soon. You don't have anything to worry about inflation. This inflation is temporary, it's transitory, and this is going to fade away and the price of things are going to fall back down. But during this meeting, the Federal Reserve Bank Chairman Jerome Powell said that he was wrong. In December 2020, when people first started talking about inflation, the Fed said that inflation might not stick around long and that inflation might hit 2% in 2021. Then in March 2021, when people realized that the Fed was wrong, the Fed came out and had a meeting and they said that this higher inflation was just temporary. In April, Jerome Powell had another meeting where he said that inflation is now, quote, transitory. This is when the word transitory became popular. In June, they said the exact same thing. Jerome Powell said the high inflation was temporary and that it would, quote, wane. Then in July of 2021, because people were still worried about inflation, that's when President Biden started backing the Fed and he said that inflation was temporary and the Fed should do whatever they deem necessary for the economic recovery. And even if we go all the way into November of 2021, the Federal Reserve Bank had another meeting and Jerome Powell said that inflation was transitory and that it will go away. Now Jerome Powell has finally admitted that he was wrong, and let me actually read you exactly what he said. This is from a Yahoo Finance article titled that the Fed Chairman Jerome Powell retires the word transitory in describing inflation, and what he said was, quote, "We tend to use the word transitory to mean that it won't leave a permanent mark in the form of higher inflation, but I think it's probably a good time to retire that word and to try to explain more clearly what we mean." In other words, it's probably a good time for the Federal Reserve Bank to stop lying to the American people, to stop telling people that this inflation is just going to magically go away, and to stop telling people that, hey, the prices of things are just going to magically fall back down, because that's not true. Now, when Jerome Powell was asked why he was wrong or how he couldn't see this coming, what he said was nobody could have predicted the factors that we saw come together. Nobody could have predicted the supply chain issues. And so this higher inflation that we're seeing that's no longer transitory was very unpredictable. Even The Economist magazine came out and they said the exact same thing. They tweeted that the sharp rise in inflation over the past year has blindsided many economists and almost no one saw it coming. Nobody saw it coming. This is my video from over a year ago in 2020 talking about how the Fed's policies are going to ramp up inflation and why you should prepare for inflation. This is my video from the early part of 2021 talking about how inflation is getting worse and why you really need to start thinking about inflation. And this is the video I made in the middle part of 2021 talking about how inflation broke a record, how inflation is not transitory, and why you really need to start thinking about inflation, especially when you're investing your money. And this is my video for more recently, just blatantly saying that the Fed is lying about inflation being transitory and why you really need to understand what the Federal Reserve Bank is doing because it can impact your money. And this is my most recent video where I just bluntly said that inflation is rising and the Fed needs to do something right now to protect the economy against inflation because the Federal Reserve Bank has been lying about the inflation being transitory. Now I understand where they're coming from because anytime I said that the Federal Reserve Bank is wrong about inflation, I got a lot of heat. Everyone said that the presidential administration and the Fed says that we don't need to worry about inflation, that inflation is transitory, so we should trust them. I even went on another person's YouTube channel and I got into kind of a debate with somebody else talking about inflation because they kept saying that, hey, the Fed said inflation is transitory. This inflation is not going to last. It's just supply chain issues. You don't got to worry about this money printing because that's what the Fed's job is. And I said, no, that's not true. And so a lot of people just assume that, hey, if the people in power say that inflation is transitory, you have nothing to worry about. So I get where they're coming from, but this is where you really just need to be financially educated. That way you can make smarter decisions for your money. But the agenda for today in this video is I want to start by talking about what happened, especially in this meeting. That way you'll understand what the Federal Reserve Bank and the Treasury Secretary are thinking about inflation and the economy. That way you can understand now what the response will be to now understanding and believing and admitting that this inflation is not transitory. And then I want to go over what will this mean for our economy and the dollar and your money. So let's start here with number one. But before we do, I need you to do me a quick favor and smash the thumbs up button below. And if you're looking for some extra guac, meaning some extra minority mindset, you can check out some of our newer minority mindset channels. We have the Minority Mindset Clips channel because you all have been asking for my shorter videos again. And on the Minority Mindset Clips channel, I'm posting my shorter videos every single day, 7 days a week. These are my shorter videos, 8 to 12 minutes long. So if you like my shorter videos, you should also check out the Minority Mindset Clips channel. We have the Minority Mindset News channel where Nate is publishing videos every single day on what's going on in the top finance and business news. So if you're looking for an easy way to keep up to date on the news, check out the Minority Mindset News channel. And then we have the Minority Mindset Spanish channel where you have my financial educational content in Spanish. So if you want to check out and subscribe to these other Minority Mindset channels, I'll put the link to where you can do that in the description below. Now, let's go back to number one. So I sat there watching this meeting with Jerome Powell, the Treasury Secretary, and Congress, and I was sitting there taking notes. And after Jerome Powell said that he needs to retire the word transitory, he also said that the inflationary pressures are, quote, more persistent. And he said that we're seeing the factors that are causing higher inflation to be more persistent. He also says that the inflationary risks have, quote, soared up. And because of these higher inflationary risks, at the next Federal Reserve Bank meeting, they're going to try to take more measures to help cool down inflation. But the most interesting thing about that is that Jerome Powell then said that, well, yes, inflation is not transitory. And yes, inflation is worse than we expected. And yes, the inflationary risks are higher. He still said that he expects inflation to cool back down in the second half of 2022. So let me diagram what that means. So I just put a little chart here with this side being inflation, 1% inflation, 2% inflation, and on. And this is the year 2020, 2021, and 2022. The Federal Reserve Bank's goal was to take this lower inflation that we saw in 2020 and try to keep inflation around 2% a year. That was their goal. But what ended up happening was they started to ramp up this inflation, and then they hit 2%, and then they just kind of boom, and then went way up here to 6%. And now what they're saying is that in 2022, their goal is to bring inflation right back down to here. The original plan, according to this inflation is transitory, is we were going to see some higher inflation, not this high, they thought that it'd be something around here, but then inflation would cool down and we would see the prices of things drop, and then it would level off at this 2% because then you would see prices of things normalize, the cost of living will go back down, and then they could kind of keep this 2% inflationary target. So now they've kind of given up on this idea, but they're saying that in the second half of 2022, we're going to see inflation come back down to around 2%. So what that means is the prices of things are going to continue going up, just not as fast as they are right now. Because right now, we're seeing inflation at somewhere between 5 to 6% a year right now, which is many multiples higher than what they were expecting and anticipating. And so now what they're saying is, okay, right now inflation is very high, but we're just trying to get inflation to go back down to normal, which means you're going to continue seeing the price of things go up, but just not as fast as they're growing right now. And actually, I just realized that I did this chart wrong because what the Federal Reserve Bank was actually hoping for was not this, is they were hoping for this, because you would need to see actually some sort of deflation in order to see the price of things go down. Now, unfortunately, but not surprisingly, this became kind of a big political game because Democrats and Republicans were both blaming this inflation on each other. Democrats are saying that the reason that we're seeing this higher inflation is because of higher demand, and Republicans were saying that the reason that we're seeing this higher inflation is because of these Democratic policies. So instead of trying to actually fix the problem, both of them were just pointing fingers at each other. Democrats were saying that all of a sudden, after this economy opened back up from the pandemic, we had this massive surge in demand for people wanting to go out and buy things, and this massive surge in demand overloaded companies, and then companies were not able to produce products, they were not able to get products because of supply chain issues, and because of that, that caused the price of things to go up. Republicans said, no, it's not because of demand, it's because of these Democratic policies, these liberal policies. They're saying that it's because of all this money printing printing that President Biden wants to do in order to stimulate and in order to build back better, these are the things that are causing inflation. Now, what I'm about to say is going to trigger a lot of people on both sides of the political spectrum, but I'm not here to make friends, I'm here to educate, so let's go right into it. So when we talk about demand creating inflation, that really doesn't make any sense, because if you look at what created the sudden demand, well, this demand to buy products came out of thin air, because all of a sudden when this pandemic hit, people stopped working and people stopped producing. But what we did produce was money out of thin air. The Federal Reserve Bank, who's in charge of our monetary policy, started printing money out of thin air, and they started giving this money to corporations and people. So now all of a sudden people were getting money, stimulus checks, unemployment checks, and they were getting money from the government. They were getting this aid, and what did they do? Well, they were not encouraged to pay their landlords because the government said that you don't have to pay your rent. They were not encouraged to pay their mortgage because the government said you don't have to pay your mortgage. They were not encouraged to pay their student loans because the government said you don't have to pay your student loans. They had forbearance for all of this. Instead, they said you need to go and stimulate the economy. They said that you should go out and buy products, go buy goods from these big corporations and these big companies. So people took this free money and then they went out and they started shopping. And they went out to the mall and started spending money. They went to Amazon and started spending money. And now all of these companies started getting orders, and they made their products not in the United States, but they make their products overseas. So now all of a sudden you had this massive demand, which came from what? People didn't actually work to earn this money. This money came out of thin air because people also didn't have any expenses, and then they were getting this money without producing. So people were getting this money, buying products made overseas, and these overseas factories are shut down. So now these overseas factories are getting overwhelmed with orders because we don't make these products in the States. These overseas factories are now trying to keep up with all this demand, and then they're trying to ship these products, and you have these shipping delays, and then you have the port delays in the United States, and then you have troubles getting the products from the ports into the factory. So you have the supply chain issues, which were then exacerbated by this demand created by what? Well, the demand was created by nothing. The demand was created by the Federal Reserve Bank. This is where then the Republicans started pointing fingers, and they said that no, it's not this demand that's creating this inflation, it are these democratic policies which are passing trillions of dollars of these new infrastructure bills, because now the government doesn't have trillions of dollars to fund these infrastructure bills, so the government has to print this money through the help of the Federal Reserve Bank, which causes more inflation. Now, obviously, more money printing causes inflation. That's what inflation is. Inflation is when you inflate the monetary supply. But we haven't seen the effects of any of these new bills yet. I mean, they haven't really entered our economic system, so we haven't felt the inflationary effects of them. And President Donald Trump also passed a $2 trillion historic stimulus bill in 2020 to help stimulate the economy. And then he passed another $900 billion stimulus bill in the later part of 2020 to help stimulate the economy. And he was pushing for more stimulus, he was pushing for negative interest rates, and he was fighting for higher inflation. So it really doesn't make sense to blame the current inflation that we're seeing on democratic policies, but you have to imagine that these democratic policies will lead to higher inflation in the future because they have big price tags that we cannot afford, and the way that you fund them is through higher inflation. But the inflation that we're seeing right now is not through these democratic policies. We'll be feeling that inflation sometime in the future. And then you had Treasury Secretary Janet Yellen and the Federal Reserve Chairman Jerome Powell say that the reason why we're seeing this higher inflation is because of supply chain issues which were caused by this pandemic and because of this worker shortage and this worker crisis that we're seeing in America. That is the reason why we're seeing this inflation. It's not due to money printing. It's not due to the low interest rates. It's not due to the bond buying that the Federal Reserve Bank has been doing for the last year. It's just due to the supply chain issues. Treasury Secretary Janet Yellen actually kind of hinted at this. She said that inflation is a matter of supply and demand, and we did see a massive surge in demand, and she said that a part of that demand was due to all the money printing that the Federal Reserve Bank did. But then she went on to say that this money printing was a very small reason for this higher demand. Which actually doesn't make any sense then. That yeah, when you have a massive demand and no supply, that's going to cause the price of things to go up. But to say that the demand was caused by a very small part due to the money printing really doesn't make any sense, because the country was not working. We were not producing anything. Yeah, we were still printing money, and so people were able to spend money like crazy because now not only do you not have any expenses, you can go out and spend money. How can you say that this demand is only a small part due to money printing. And then on top of that, you also have extremely low interest rates, which also cause more inflation. Remember, inflation is when you inflate the monetary supply, when more dollars enter our economic circulation. Well, when you have low interest rates, well, that makes it more likely for people and businesses to borrow money, because when interest rates are low, you're more likely to go to the bank and borrow money. You're more likely to go out and get a mortgage, and corporations are more likely to go out and borrow money because now they can borrow money for 3, 4, 5% interest and invest this money back into their company. If you can go out and borrow money at 4% a year and you are a multi-billion-dollar corporation and you can grow your company by 6% a year, well, now you are making billions of dollars off of this money because you're going to borrow money, billions of dollars at 4%, and all you got to do is grow your money by more than 4% for it to be profitable. And some of these big companies can reinvest this money back into the company and grow by 4, 5, 6, 7, even 20% a year. And so when you have low interest rates, it contributes to more inflation because now people are going to be more likely to go out and borrow money. And then they went on to kind of argue that this inflation that we're seeing is kind of a good thing because it shows how strong our households are in America, because the households in America have the buying power to go out and buy things even at these inflated prices. And so it shows that, hey, Americans are doing great. We have the money to go out and buy things, even though a lot of this money wasn't directly from producing things, but Americans have the money to go out and buy things. So the stimulus by the government and the Fed worked because now Americans are able to go out and buy things, even though now many Americans are struggling. Many Americans are going back into credit card debt. People are getting behind on their mortgages. People are getting behind on their rent. People are struggling to afford this higher cost of living because now home prices are higher, rental prices are higher, car prices are higher, grocery prices are higher, gas prices are higher, vacation costs are higher. Everything is getting more expensive, and what they said is this is a sign of a strong economy. People struggling to pay their bills is the sign of a strong economy. Makes a lot of sense. Then after all of this debate, that's when Jerome Powell said that it's no longer his view that these price hikes, this inflation, is temporary or transitory. He expects these price hikes to stay for a long time or forever, and his goal is now just to bring inflation down to a reasonable level, which in his mind is 2%. So his goal is in 2022 to bring inflation back down to 2022. So now that we understand what happened to get us to this point for the Federal Reserve Bank to finally admit that this inflation is transitory, let's talk about what they're going to do now, because they did propose some solutions on how they plan on trying to control inflation. This is where now you got to understand what they plan on doing, because if you know what they're planning on doing, that can give you a better idea of what you should be doing with your money. That way we can come out of this entire financial mess a financial winner. So before I get into what you need to do with your money, we got to talk about what the government and the Federal Reserve Bank plan on doing. Now, when I talk about the government, I'm talking about what Treasury Secretary Janet Yellen was talking about. And you have to understand that the government is separate than the Federal Reserve Bank. The Federal Reserve Bank, although it's called the Federal Reserve Bank, is not a bank because you and I can't go there to deposit money. It's not a reserve because they don't keep cash reserves in a vault anywhere. And they're not federal. They even say so on their website. They are not a federal entity. They work separately and independently than the federal government. So you got to understand that the Fed and the government are two separate things with two different goals. And you'll see that here. So starting on this side of the government, Treasury Secretary Janet Yellen said that yes, inflation is a problem, but the real way that we fix this problem is to let people go back to work. But the concern is now this new variant, because that's making people scared to go back to work, and it could create more restrictions, which would make people less likely to go back to work. And so she says that the solution is really for this pandemic to end, to let the economy to go back to normal, and to pass the Build Back Better, I'm going to label it BBB, the Build Back Better infrastructure package that President Biden is pushing for. This is a almost $2 trillion package to help stimulate the economy some more, to help create new jobs, and also to help control and slow down inflation. So this Build Back Better plan has a price tag of right around $1.75 trillion. And this goal is to improve the infrastructure in America, to help improve the supply chain issues, to hopefully help give more people jobs, and to help the economy grow and recover. When she was asked how is spending more money going to help slow down inflation, what she says is it is going to create a way for more people to go back to work, because this is going to reduce the burden on people, especially women, when it comes to childcare, because this Build Back Better program is supposed to help provide for early childcare for children pretty much universally. So free young age childcare for young people. And so now you can send your kids to daycare, this childcare for free. And so now you'll be more free and more likely to go back to work. Now, the concern is, well, okay, you are now sending your kids to childcare and this is supposed to pay for that, but what happens now if childcare costs go up? Because like we saw happen with college tuition, as soon as the government guaranteed federal student loans for anybody that wanted to go to college, colleges started jacking up the price of the tuition. That's why college is so expensive now, because they know that they're going to get paid. And so if daycare companies and these early childcare companies hear that, hey, the government is going to guarantee that we get paid, we can charge more money. And that also means that, hey, I can go and give my kid free childcare. Let me go and send my kid to childcare now because I wouldn't have done it before because I couldn't afford it. That means the cost of this childcare is going to go up. And that means that the projections that they use to come up with these costs are probably going to be significantly less than what the actual cost will be. So their goal is now to provide more assistance to parents and young families. That way more people can go back to work, but chances are it's also going to cost more money. So in the best case scenario of this, it will allow more people to go back to work. It will allow our infrastructure to improve, and this will in turn allow inflation to go down because we'll be more productive in society. If it doesn't work, well, then that means we're spending a whole lot of money because the United States government doesn't have another $2 trillion. We would have to print this money through the help of the Federal Reserve Bank, which means that now we would see more inflation. If we don't print this money, well, then we would have to raise taxes. And chances are we're not going to be able to raise enough taxes to pay for all of our government spending. So the government might raise taxes and then cover the rest through inflation. So you could see higher taxes and higher inflation in order to pay for it. And even some economists have come out and said that this will for sure cause inflation in the short term, because that is what inflation is. Inflation is when you increase the monetary supply. But the government's goal is that hopefully over time, this will bring the price of products back down. But again, the concern that she talked about is this virus, because now you have this new variant which is creating new lockdowns, new restrictions in countries around the world, which is going to cause more supply chain issues. And even in the United States, what they talked about is now more people are going to be scared to go back to work in the States, which means more supply chain issues in the United States because you have less workers in the United States, higher unemployment in the United States, which would exacerbate this supply chain issue, which could cause the price of things to go up even more in the short term. Jerome Powell also had an interesting response to this high inflation. What he said is that now that he has admitted that this inflation is not transitory, they want to take more drastic and more serious measures to try to address this inflation without trying to panic the public, without trying to panic investors. So the first thing that they said was that they want to taper more quickly. So if you remember, when this pandemic first started in 2020, the Federal Reserve Bank started unlimited quantitative easing. Essentially what that means is unlimited money printing. And what they were doing was they were printing money, and they were using this money to buy bonds, to buy assets, to keep investors confident in the market, to keep people pouring their money in the markets, and to help the market go up. That's why you saw the stock market crash when people started to get worried about this pandemic in 2020. And then as soon as the Federal Reserve Bank came out with this unlimited quantitative easing program, the stock market essentially, boop, shot back up. It was because the Federal Reserve Bank started buying all of these bonds, started buying these assets to help prop up the markets. Well, after the stock market started going up, what the Federal Reserve Bank said is that they would continue buying $150 billion worth of these assets every single month. And they continued to do this through 2021, through October of 2021. And then they finally came out and said that they would start finally tapering these bond purchases. So now they're tapering these bond purchases by about $15 billion a month. So it would take almost a year, about 10 months, to finally taper down all of these bond purchases. But this is where Jerome Powell said, okay, inflation is an issue, and he's talking about tapering these bond purchases even faster than what he previously thought, because he's worried that this slow kind of taper would help cause inflation to grow even faster. So he's more worried about inflation now, which is why he wants to taper these bond purchases even faster. That would mean less money printing every single month. And then the second thing that he talked about was interest rates. So I'm going to label this INT rates. So what he said about interest rates was, first, that they're not going to even consider raising interest rates until this bond tapering is completed. And even during this meeting with the Financial Services Committee, They talked about how, yes, he wants to raise interest rates, but he said that there's no need to rush raising interest rates yet, which I thought was a very interesting thing that he said, because he does seem a little bit more concerned about inflation. And these super low interest rates are really contributing to inflation, but he does not want to panic investors, does not want to panic people yet. But kind of naturally, if they don't want to raise interest rates until this tapering is done, and they taper these bond purchases sooner, well, then the problem means that they're going to raise interest rates sooner. And I dug a little bit deeper into this. And if you dig a little bit deeper into this, you start to really see the dilemma that the Federal Reserve Bank is facing right now. Because on one hand, you have this worry of stagflation. Stagflation was this thing that we saw in the 1970s, where you had a period of high inflation and low economic growth. So during the 1970s, we saw an average inflationary rate of the decade of just under 7% a year. You saw some years that were significantly higher, some years that are a little bit less, but over the 1970s decade, inflation was just under 7% a year. So it was very high inflation in the 70s, and the way that they were able to cool this inflation down was they had to ramp up interest rates in the 80s. So in the early part of the 1980s, if you wanted to go out and buy a home, your mortgage rate was not 3 or 4%, it was 18.5%. So the only way that they were able to control inflation in the early 1980s, and the only way that they were able to control the stability of the dollar, was by ramping up interest rates, because that was the only way that they could contract the monetary supply to slow down inflation and to cool down the economy. That way the dollar could continue to be strong, that way the economy could continue to be strong for the long term. So that's the first issue, is if you continue just printing more money, well, then you would cause more inflation, and we do not have the economic growth that we're seeing right now. Although no one says that we're in a stagflationary environment, the Federal Reserve Bank and the government have said time and time again that we're not in stagflation, that we're not at a risk of stagflation. Although during this meeting, they did say that we are in a low economic growth environment and we are in a high inflationary environment, which by definition was stagflation. But they're still saying that we're not in stagflation yet. So we'll see what goes on with that in 2022. But the concern is if they continue money printing to grow the economy, then we do risk this type of stagflation, which means that, hey, we might have to fight it, which means we might have to raise interest rates significantly if that does come to fruition. And if we have to raise interest rates significantly like that, that could cause a stock market crash and a real estate crash and a real economic slowdown, because everyone is so used to these super cheap interest rates. And if interest rates start to skyrocket, well, then no one's going to want to buy a home, because already home prices are so expensive. And you're going to see stock prices come down because it's going to be much more expensive for companies to borrow money. So that would create a correction or crash in these asset markets, and nobody wants to see that. So that's the first hurdle that the Federal Reserve Bank is trying to fight, because if they create too much inflation, then we risk stagflation, which means that we would have to ultimately fight stagflation, which would lead to a slowdown in our economy and these asset classes, which a lot of people don't want to see. But on the flip side, we also have this virus and this variant, which is posing a lot of risks for our economy. Because now, if this variant continues to be an issue, and if we start to see more lockdowns overseas and around the world, and if we see more restrictions inside the United States, well, that means we're already seeing an economic slowdown. And that means we're already going to be seeing more supply chain issues, because it's going to be harder for us to source products from overseas. And it's going to be harder for us to create more products here, because you'll have less people working. And anytime we see an economic slowdown, or anytime we saw an economic slowdown over the past 18 months, that was when the Federal Reserve Bank worked to create more stimulus. So right now, the Federal Reserve Bank has just admitted that inflation is an issue. And they admitted that they want to taper this faster. But if our economy slows down more, well, then they might be pressured to create more stimulus, when more stimulus will ultimately hurt our economy for the long term. This is what we've been talking about for the last 2 years, that stimulus is a way for you to stimulate the economy in the short term, but you got to pay the price over the long term. The issue now is we're starting to realize that, hey, we might have overstimulated. If we overstimulated, that means that now we have to pay a much bigger price in the long term. And so now if our risk is, hey, this variant, this virus is slowing down the economy more, and the Fed feels pressured to now do more stimulus, maybe now ramp up tapering instead of slowing it down, and maybe keeping interest rates lower for longer, well, then now you risk, again, more inflation, but then you also have slower economic growth right now. So it's like, do you want to see the slow economic growth right now? Do you want to be that person in power to say, you know what, we are going to deal with the cause and the pain of this right now. That way we can be a stronger economy. That way we can continue to protect the value of the dollar. Or do we want to inflate and create more stimulus right now and create a boost right now, which is good, especially during election time, because nobody wants to see a slowdown in assets or the economy when it comes time for midterms or presidential elections? Or do you want to be the bad person and say, you know what, screw it, we're going to actually take care of the economy and we're going to let things cool down, that way our economy can refresh. And this, interestingly, is where you started to see a little bit of finger pointing, because you saw people blame fingers here. You saw Treasury Secretary Janet Yellen say that now, you know what, it is the Fed's responsibility to make sure that this type of inflation does not get out of control. It is not the government's responsibility, because she said that it is the Fed's responsibility to make sure that there's no wage price spiral where prices keep going up, causing wages to go up, causing prices to keep going up, to cause wages to keep going up, to cause prices to keep going up, to cause wages to keep going up, and on and on and on, due to this higher inflation. Because if the prices of labor go up, then you have to raise the price of your products, which means you have to ultimately raise the price of your labor, because then people can't afford anything else, which means you have to raise the price of products. So she said that it's the Fed's responsibility, and the Fed kind of said that, you know, we can do what we can, but we can't control the supply chain issues, we can't control everything. So that's kind of the response, where now you have these two entities fighting each other. This is what the government wants to do, this is what the Fed wants to do, which brings me to number 3, where now you got to understand what it is that you should be doing with your money. So when it comes to understanding what you should be doing with your money and what might be potentially coming, you got to look at, okay, your cash is being devalued in your bank, but this poses a risk because inflation makes your buying power of your money less. It makes the value of your earnings, your salary less. But now if you take all of your cash and you go out and you buy assets, you buy stocks, you buy real estate, whatever, and then the price of these assets drop, well, now the price of your money has dropped and you don't have money to go out and buy more assets. On the flip side, if you keep all of your money in cash, and now your cash is being eaten away by inflation, well, you could see the price of stocks and real estate to go up. So this is where it's really hard trying to perfectly time or predict what's going to happen. And so my goal is not to try to predict what's going to happen, but to understand what might happen. That way I can make smarter decisions with my money right now. We really have a whole kind of spectrum of things that could happen. You have a best case scenario, a medium case scenario, and then the worst case scenario. So the best case scenario is you have the Federal Reserve Bank that starts tapering these asset purchases, and then hopefully they start raising interest rates, and they do this slowly enough so it doesn't affect home prices. They do it slowly enough so it doesn't affect the stock market, and this helps get the economy moving stably. And you also have the government that's passing these government proposals, which has to be funded through somewhere, but they're able to raise enough tax dollars without causing massive amounts of inflation. And so the government and the Federal Reserve Bank do these policies, and this variant doesn't cause major risks to our supply chain. It doesn't cause major risks to our economy. If that happens, if all those situations happen, this would lead to our best case scenario, which is that our economy continues to grow very quickly, more people go back to work, our supply chains go back to order, and then inflation will cool down, and we'll start to see the prices of things not grow as fast as we're seeing it happen right now. So this would be inflation coming back down to the 2%. That is the best case scenario. This is what the Federal Reserve Bank and the government is hoping for right now, that we can just cool down inflation, and that in 2022, we finally get inflation to just come back down to 2%. Their original goal was to see that happen in 2021. Now their goal is to see that happen in 2022. So that is the best case scenario. The medium case scenario is similar. So the Federal Reserve Bank and the government pass their proposals. The Federal Reserve Bank does some of their tapering, but now you have the effects of this variant really starting to come in, and so the Fed can't really taper or raise interest rates as fast as they would like, and maybe these raising interest rates slow down the stock market, they slow down the real estate market, and the government proposals do cause some more inflation in the short term. And because of this variant, we see a slowdown in our economy. We see a slowdown in our labor market. Well, now we are really starting to enter a stagflationary period. This would be somewhere kind of in the middle, where now you face a stagflation, where now in order to fight this, we really have to start raising interest rates more. And now when you're raising these interest rates more, that causes a more slowdown in the stock market. So you can see stock prices correct, you see real estate prices correct, you see slowdown in the economy. And this could take years to really recover and get past. This would be a medium case scenario. The worst case scenario is now the Fed is trying to taper their policies, but then this variant comes in and they have to now start doing more tapering, they keep interest rates low, the government is passing more of these infrastructure bills, the government is spending more money, so now you are seeing inflation ramp up. And now you're facing some sort of dollar crisis where, yeah, maybe it's kind of like stagflation, but a little bit worse than stagflation, where you have very high inflation and people start to lose trust in the United States government. You have countries around the world that are holding trillions of US dollars. They start to worry about the health of the United States dollar. They start to worry about the health of the United States economy. And then they start dumping the dollar. This would affect the credit worthiness of the United States government. And if that happens, that really causes a major problem in the United States Treasury market. United States Treasury bonds were considered the safest investment for like the last century. And if that no longer becomes a safe investment, then many people would see their retirement plans get hurt. You'd see countries around the world start to get hurt, and it would create a major economic crisis worldwide. So you'd be seeing higher inflation, higher unemployment, and a worldwide economic slowdown, and it pulls us into a whole second recession, maybe even a depression, because now you have the value of the dollar in question. So now that we know that it's going to be somewhere here, what do? Because we don't know if it's going to be here, here, or here. Well, what you can do is position your money in a way that you are protected in case we see high inflation. You position your money in a way where you benefit in case we don't see major inflation and we continue to see asset prices rise. And you protect your money no matter kind of where you are here, because you want to make sure that you come out of this financial mess a winner, which is why you want to make sure that you're financially educated. The way that I do that, and again, this is just my opinion, I cannot tell you what to do, which is why you need to always do your own due diligence, because investing has risks. You are never guaranteed to make money when you invest, which is why you should never blindly listen to a random guy on YouTube. I invest my money in 5 different places: real estate, stocks, businesses, cryptocurrency, and physical commodities like gold, because then this gives me protection kind of no matter what happens. So I'm still actively buying stocks and real estate, but I'm being pickier than I was before. I'm looking for deals that I believe are undervalued. Yes, you can still find them, but yes, it is significantly harder now than before. So I'm not trying to chase my investments. I'm looking for an investment that I believe is a good value, something that I want to own for the long term. But I also have my passive investment strategy. So every single month and every single week, I have money that's being used to go and invest into certain assets. So every week, I have money that is leaving my account and being invested into the stock market, into different ETFs. This happens whether the market is up or down. I also have money that's automatically leaving my account and being invested into some cryptocurrencies, and this happens every single day, whether the market is up or down. I also have some money every single month leaving my account that's buying me some physical gold. That's happening every single month, whether the market is up or down. This is kind of my protectionary, my more passive investments, because these are things that I just want to own forever. These are the things that I want to own for a long time. So I don't really care what's going on in the market, and whether it's up or down, I'm just going to be buying. And then anytime I see the prices of assets go down, that is again another opportunity for me to come in and buy more aggressively. You don't need a ton of money to really do any of this. You can start creating passive strategies with as little as $10 or $100 or $1,000. It does not matter. You don't need a ton of money to start doing this, but you just have to start doing something with your money, because you have to understand that if you keep all of your money in cash, well, now the risk is, well, your cash is going to be devalued because of inflation. But if you get rid of all of your cash, but then the other risk is you have no cash to go in and buy the dip if you start to see the prices of assets go down. So you got to be smart, and you have to understand that there are different goals with different assets. And that's why when I talk about diversification, you want to have real diversification, not just diversification within one asset class, because most people assume that diversification means I have some growth stocks, I have some innovation stocks, and I have some emerging market stocks. So I'm diversified. But if the stock market crashes, all of your stocks will be hit. And so you want to make sure that you're protected. That's why, if the value of the dollar goes down, I own something like gold and Bitcoin. And so now if the value of the dollar goes down and stocks don't crash, you could actually see the value of stocks go up relative to the value of the dollar, because the dollar went down and now you need more dollars to go out and buy stocks. In which case I could sell some of my physical gold to go out and buy stocks. And so you just kind of got to understand what each asset's purpose is, that we're allocating your money in a way where you can benefit from no matter what happens. And this does not mean that you need $1 million or $100,000 or even $10,000 to start. You can start doing this with a whole lot less, but you have to get financially educated first. Then you have to start making the right decisions with your money, and you have to actually take action. Yes, it is risky. Yes, you can lose money, but you have to start doing it if you really want to start seeing the benefit. If you want to learn more about how to start, we have tons of videos on our YouTube channel you can watch for free. You can check out our website, theminoritymindset.com. We're publishing articles every single day, and we also have a free guide on how to invest your money in the stock market. This guide will walk you through what stock market investing is, how to come up with a stock market strategy, and how to build wealth in the stock market. You can read this guide for free when you sign up for our daily newsletter. So if you want to read our free stock market investing guide, I'll put the link to where you can do that in the description below.
The problem the Fed has is that if it admits that inflation is here to stay, well, then it has to do something about it. But it can't do anything about it, because if it does, the economy will crash, right? The stock market will crash, the bond market, the real estate market, and the government will be forced to slash spending.